What's up? It's Rowan here from Artist Smart Education with the weekly HSC Economics stats update. The RBA has just dropped a cash rate decision. They've reduced the cash rate. So in this episode, we're looking at all things cash rate, the rationale behind the drop. We're going to be looking at, in addition to that, recent wage price data from the ABS, what that means for annual wage growth. And so we're going to be looking at all of this in particular, very important for both the inflation topic of the HSC Economics course and both monetary policy and even labour market policy in topic 4. So if it's your first time dialing in these episodes, I share the key stats and headlines around the domestic and global economy, giving you the insights you need to unlock a band 6. So in short, the RBA has dropped the cash rate, okay? Now, they've dropped the cash rate by 25 base points, and the reason they've done so is because ultimately they're acknowledging that inflation is now in the target range. Now, in last week's episode, we looked at a deep dive at the rate of inflation. Now, for those of you that didn't watch, the underlying rate of inflation, so quarterly, trimmed mean, get rid of the top 15, get rid of the bottom 15% of movements, that trim mean finally went sub 3. It went to 2.9%, which is fantastic. Now, the result is such, though, that it's under the 3% high end of the bracket. Now, the headline was also 2.4%. So we're in a situation, we can see this here, where as a result, right, this is sort of the January data that they have, January 2025, okay, we can see trim mean was 3.3, and CPI, ultimately headline was 2.4, and we can see that, they've now got a forecast for June 2025, that's middle of this year, where they're expecting the trim mean to remain in the smack middle of the of the target range of 2 to 3%, 2.6%. So basically, in essence, they're acknowledging that, look, we expect now that inflation is going to be back under control. And you can see here for the entire period, okay, going all the way up to July 2027, they're really expecting, okay, that it's going to remain at the moment in terms of their forecast that the trimmed underlying mean will remain, okay, in the middle of the range. So that creates less pressure on the need for rates, for a tightening cycle of rates. Now, do note here that they are acknowledging that they do expect, that, okay, the underlying will continue to drop to 2.1, and then it'll start to increase again. And the underlying will go again above, 3%. Now, note, we're in a pretty unusual situation here where underlying is actually greater than the headline. Typically, headline is often greater than the underlying, and that's because headline usually includes those really volatile one-off factors, and they tend to be often inflationary factors. Right now, though, there's a fair bit of government support in place. For example, energy rebates. Now, those energy rebates are making a concerted effort to reduce inflationary pressure, and that's basically being reflected in the headline rate of inflation. So the RBA is acknowledging that as those government sort of supports start to unwind, the headline will increase. But remember, the one that they focus on is the underlying rate, the trimmed mean, which is going to be 2.6%. So there is an expectation here, okay, great, because we've now got it under control, we can start to consider lifting, the sort of, I shouldn't say lifting, I should say reducing, but removing is maybe, or lifting the tightening setting that they've had on the cash rate. Now, note, why are they doing this? Well, again, ultimately, they've got both the labour market and economic growth as their two other sort of broad objectives. And, full employment is, being elevated to sort of number one alongside inflation, but economic growth is still one of the key factors. And what they've identified is really, they do see an increase in global uncertainty, okay? Now, a lot of that is to do with, both, Trump's sort of tariffs and both the financial market havoc it's been creating in terms of, the back and forth in terms of are they not going to be there? That's creating a lot of uncertainty, okay? It's creating a lot of global uncertainty, but also for businesses as well and for consumers in terms of how should they be evaluating future spending decisions. So that expectations, both business and consumer expectations, have real effects on the economy. If you think that the economy is going to not be doing as strong in the future, you're going to change your decisions. You might spend less now because you're wanting to save, right? You're wanting to make sure that you've got enough buffer for when things get tough. And in doing so, you reduce your consumption, which in Australia, 60% of our aggregate demand is consumption. So it plays a really key role. So they've basically identified, well, look, we have a concern about that, and we're mindful. We want to really support that economic growth. Now, they are expecting unemployment to increase a little bit, okay? It's still very, very low. They are expecting, although they've been surprised by the fact that it hasn't perhaps increased as much as they thought. They're still seeing tighter conditions in the labour market than they would have expected. And in part, that's why they've also been keeping the cash rate tighter because they were concerned that that could continue to create inflationary pressures. So they're thinking that as a result of economic growth starting to maybe, be a little bit weaker, okay, that we might see some of that, unemployment rate increase as a result of the decrease in aggregate demand. So, when we think about this, okay, what we've got is we've now got a cash rate that is at 3.85%. So it's now sub 4%, and we've now had our second really, cash rate easing in terms of what's happening. Now, a couple of small little additional things to highlight. And so you can also jump into the media release of the statement, which goes into, a little bit more depth, okay? And as it highlights here, they are definitely concerned about the geopolitical risks and the global volatility. In saying that, they are mindful that while this will, and it has contributed to weaker outlooks for growth for Australia, which it has, the IMF has reduced Australia's economic growth sort of figures, employment and inflation, the reality is because it's changing so rapidly, it's actually also very hard to make policy settings. And so what they're sort of saying here is, yes, we're aware that this is an issue and it's impacting confidence, but it's also one that we're going to have to continue to address almost essentially month on, month out, based on how that plays out, okay? Now, ultimately, they are reiterating that inflation is still the absolute main priority. However, they are balancing that with ultimately, the risk that actually, it goes too low because economic growth slows too much. So there we have it. That's a bit of an unpacking of the cash rate decision. Now let's look at some other data that has also dropped, and that is the wage price index. Now, this is really important because since COVID, we've seen really a significant erosion of real wages. Now, remember, real wages are essentially where you look at, wage price index, so the increase in wages, and you compare that with inflation, and the difference is the growth in real wages. So if you have a situation where, wages are not growing as fast as inflation, i.e. inflation is growing quicker than wage growth, you've got an erosion of real wages, i.e. wages can purchase less. Right, so you've got lower purchasing power, and that has a material impact on quality of life, and ends up having an impact on the levels of economic growth as well. So ultimately, right, what has happened is we've got some really positive data that's come through. So over the 12 months to the March 2025 quarter, the wage price index rose 3.4%. Okay, now the private sector rose 0.9%, public sector rose 1%. So seasonally adjusted over the quarter specifically. Okay. Now, ultimately, we can see that the largest contributors were healthcare and social assistance, education and training. So in other words, what that's telling you is actually the government, right? Like, because most of those are big government-based, okay, in terms of employers, have played a pretty key role in driving wage growth. And that has been the case in recent sort of quarters, where the government in many respects has been both, through its, fiscal policy, right, both propping up some of, employment in the country where maybe it would have been weaker than it has been, but the government has been a major employer, but also driving wage growth. Now, the positive here, right, is if we think about it, and we can see here that we've got 3.4%, well, if we remember that the headline rate of inflation was 2.4%. So what this means is that ultimately, right, we have real wage growth of 1%, which is really fantastic. Now, if we dive in and take a look, right, it does give you, like per sector, private and public, okay? And so we can see here, okay, as a result, right, we've got a private sector that, has now dipped. So for some time, the private sector was certainly leading wage growth, and we've seen a recent dip where the public sector is now outstripping that. And that's exactly what I highlighted seems to be the case when you look at the industries that have contributed in certainly the most recent quarter to that wage growth. Now, if we go and have a look, the ABC has some really great sort of data on this as well, okay, that we can take a look at. So why did wages increase? Their take on it, according to Michelle McQuart from ABS, is that jobs covered by enterprise agreements contributed to half of all quarterly growth. So this is a great stat that you can use when you're looking at the labour market and you're looking at the role that different types of wage determination can play both on wage growth, real wage growth, living standards, but also productivity. So enterprise agreements here have played a big role, okay? They have highlighted that in the private sector, the wage growth was largely, influenced by administrative wage adjustments due to the aged care work value case at the Fair Work Commission. So in other words, it hasn't been because the private sector has voluntarily decided to increase this. It's because of really the role that the Fair Work Commission is playing, okay? And also, right, there's been, the government driving wages in early childhood and education. Now, note, we can see here if we take a look, this is the breakdown of private versus public. So they've got a different format to show us the sort of annual, right? And we can see that, private sector has gone to 3.3, public is 3.6. Now, note, the thing to highlight here is that if we were talking about private sector, it does show that then private sector less inflation of 2.4 means, that it's still ahead, okay? It's just not as ahead quite as much as the public sector. But it does show that, again, the public sector, the government is playing a key role in really trying to drive wage growth and therefore also influence consumption in the economy. Now, the thing that we can see here is this is wage growth, okay, real wage growth. So you can see, as I was highlighting, that real wage growth during the COVID period. So where, like COVID here, there's a bump here, and that initial bump comes from the fact that, there was a lot of government stimulus. Inflation had not yet really kicked in. In fact, it was deflationary during that period. Because of the level of uncertainty, prices were falling. But we can see here that we had a massive drop to the point where we've had really, significant a number of years, right? Really 2021 to 2024. So 3 years consecutively of real wage erosion, okay? Now we've finally started seeing, and you can see that's been on an upward trend, which is really great to see, and that's now been a 1% real wage growth. Now note though, that increase is much smaller than the overall decrease that's occurred here. And so the net effect, okay, is that we have not recovered the loss of real wage growth that occurred during this period in purchasing power. And that's going to take many, many more years to be able to do so. So how can you use this? Again, this data is fantastic, both when you're talking about inflationary pressure, cost push inflation in the inflation topic of HSC Economics, but also you can utilize this data when you're evaluating labour market policy, microeconomic reform, and just the role that wage determination systems can play in driving wage growth, but also in influencing inflationary pressure in the economy.